it really does feel like the tokenization floodgates are about to open. And I think there just needs to be a couple of first movers to make that happen and to create those, the sparks to create those network effects. But I think there's a lot of institutional money on the sidelines waiting for sort of these first moves as well.
Hey everyone, welcome to the Smart Economy Podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we're joined by Cian Breathnach, the founder of Matariki Labs, a contributor to Keel, Solana's capital engine. In this conversation, we discuss the value of capital formation, the current state of overcollateralized lending markets, the current and future demands for tokenized RWAs, how to maneuver contagion from DeFi risks, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the guest or host might hold tokens discussed in any given episode. You can check out a full disclaimer at www.neonewstoday.com. If you enjoyed this episode, please consider rating and reviewing it on your favorite podcasting platform and sharing with your friends and family. Every rate, review, like, and comment really does help us reach more people and bring you more of your favorite guests. With all of that said, I really enjoyed speaking with Cian, and I hope you enjoy the conversation too. Hey everyone, welcome to the Smart Economy Podcast and happy holidays in advance. Today we're joined by Cian Breathnach, the founder of Matariki Labs, a contributor to Keel, and Keel is building Solana's capital engine. How you doing today, Cian?
Good. I forgot my festive wear, but I'm certainly admiring yours. Good to be on. Thanks for having me.
I should have showed that we're going to do a little Christmassy stuff, but whatever. So it goes. This is showbiz. We'll just move on next time. Yeah. Awesome. I'm super excited to have this conversation today. So to kind of like get this out of the way, we did have one of your, I always view the kind of like Sky ecosystem as like co-opetition. There's like competing, but there's also collaborating. So we had Spark, who's building in the Ethereum EVM ecosystem. And now I'm really excited to talk to you about Keel, who's building a capital engine in Solana. But before we kind of go down the crypto rabbit hole and what you're building at in the Keel ecosystem, I do just kind of want to get like a little background into you. If you go to your Twitter page, it says that you were formerly an actuary. So what were you doing before you ended up in the blockchain world? And what was your path that led you into building here?
Yeah, definitely a good question. Not surprising to me to find that not so many people know what an actuary actually is. So yeah, I mean, I had a former CEO that I worked for used to describe actuaries as sort of the Navy SEALs of finance. I think that definitely overly glamorizes it, but it's sort of a utility belt of skills that's very, very useful for kind of big financial institutions like insurance companies, reinsurers, banks. And that's where I started out my early career. So it's kind of a very interesting blend of skill sets across macro and micro financial economics, accounting, a little bit of computer science, and then just a ton of math across, probability, risk, statistics. So a very, very interesting skill set and very, very interesting place to start out your career working for these, big traditional organizations. And it was always for me in the overlap between actuarial skill set and kind of engineering or building these risk systems and capital engines. So you can probably imagine I always had a little bit of an eye on DeFi, always curious what was happening there. But my sort of big red pill moment was with Solana and Serum. I think it was during the first COVID lockdown. I was in New Zealand at the time, and that was sort of when it all clicked for me, right? Where you can have these open permissionless systems, you get all the benefits of interoperability. And now for the first time, you can actually do it at basically negligible costs, at sub-second finality. And I think, at that stage, that was the beginning of the end for my traditional actuarial career. Started learning Rust, started figuring out how to become a protocol engineer. And since then, I've had kind of the opportunity to be contributing in various capacities in Solana and different Solana projects. And most recently became involved with the Sky ecosystem shortly after USDS came to Solana. So building out Matariki Labs, which is a team of contributors, largely Solana native, across both of my loves, both protocol engineering as well as some folks with risk and actuarial backgrounds. And so we've been involved in Sky basically since early this year, building out infrastructure for the Solana virtual machine for Sky for the first time, building those relationships and establishing who are the partners in DeFi that Sky needs to be in conversations with. And really, I guess to summarize, just generally laying the groundwork for what now has evolved to become Keel and Keel in its own right being a project from this point onwards.
Cian, so I'm interested then because a lot of times when we just look at projects that are building in blockchain and crypto, you find a lot of people who are creating a problem for a solution. And while you were kind of still doing your actuary work, you were in the traditional financial world. Were you seeing these friction points that DeFi solves? Were you running into them? Or was it kind of like an aha moment after, hindsight's 2020 and you started getting really interested in DeFi and you're like, oh, this was an issue that I didn't realize before? Or were these kind of like friction points apparent while you were still in your previous career?
In some senses, I think TradFi is miles ahead of DeFi. In other senses, DeFi is miles ahead of TradFi. I think certainly at the time when I first got interested, the thing that was exciting was that you could very quickly build these open permissionless systems. You could have movement of funds. You could have smart systems to interact with one another in a composable way, and you could do that relatively quickly and relatively without having to ask anybody else for permission to do that. Now that has its pros and cons. And that was, compared to a world that I worked in at the time where maybe adding a single field to a database might take 3 months of work from 6 engineers. And so this sort of excitement that you could sort of get these experiments and get these products off the ground so quickly and test them and get users and get folks to interact and get, real capital and real funds moving was just incredibly, incredibly exciting. And a very refreshing change from, the big traditional institutions. But then on the other hand, I think we're now at the stage in DeFi where there really is reaching a very significant scale, right? A scale that TradFi is now setting up and taking interest. And there's actually a lot of things that we can learn from TradFi and apply here, hopefully in a way that doesn't, unduly slow it down or doesn't like stymie innovation, but in a way that can help us make more robust systems, make systems that are more attuned to risk and are doing this in like an all-around more sustainable way. So I think there's certainly lessons from both. That's probably a very actuarial answer. I'm very excited to be at this point in time and this point of maturity where DeFi really is starting to round out and mature.
Mm-hmm. And when you were learning Rust to kind of get your feet wet in blockchain land, what were the kind of projects you were initially building? Were you just kind of like playing around and trying out new applications? Were you trying to contribute to projects that were building in the Solana ecosystem? What was kind of like the thing that you were doing to gain your experience in Web3?
Yeah, I mean, my very first piece of experimentation were with some hackathons. So Solana has run quite a large number of very successful hackathons, and that's a really, really great opportunity to cut your teeth with experiments and try things out in a short space of time and get feedback and get use. And they were very, very exciting in the early days. And actually, a few members of the team have been involved in projects that have either graduated from hackathons or been involved in various ways. So that was certainly, for someone who didn't come from a formal engineering training, a really, really exciting way to get involved. So a couple of different things, early days in prediction markets, building on stuff for clubs, couple of evolutions of that project, always sort of in the area of risk and kind of movement of capital. But certainly the most exciting of those has very much been in laying the groundwork for Keel. I think it's really a project at a whole other scale of opportunity and a whole other scale of kind of value creation for the ecosystem more broadly.
Yeah, one of the things that kind of brought Solana to my radar was Breakpoint 2023, when you just saw the massive amount of developers that were getting into that ecosystem. And this was just before the kind of like meme coin cycle that brought Solana to the front page of everybody on crypto Twitter's feed. And I just remember seeing the sheer amount of developers that were participating in Breakpoint, and having been in the blockchain space since 2017, you kind of follow where the developers are going. And it seemed like for the first time that finally, we had Bitcoin and was able to capture developers up until 2017. Ethereum was able to capture developers up until 2022, 2023. And then Solana was kind of like the third iteration, the third ecosystem that was capturing brand new developers that were coming to Web3. So what was it about Solana that caught your eye? What was it about the tech stack that made you think this is where I want to build, as opposed to building in EVM land or even in Bitcoin land?
Yeah, I mean, I have to admit, it certainly wasn't the low level details of how the virtual machine or the language works that got me in. It was very much the UX. I have to admit, the low gas costs, near instant finality. I think had I known how much more difficult it is to learn Rust and learn some of the Solana programming paradigms versus some other networks, I'm not sure that it is where I would have started. But it's one of those things I think once you get there and once you appreciate the benefits that comes from that additional work, I think that's why you see a lot of folks who've dabbled in Solana, they don't tend to go back. But it is really exciting, right? And I think you see this within the ecosystem, particularly in the last kind of 18 months, let's say, where a lot of ecosystems start by just replicating primitives that exist on other networks. We're really starting to see new concepts and new primitives evolve on Solana that take advantage of the unique properties of Solana, right? That wouldn't be feasible on other networks for various other reasons, where they can't have settlement and the high frequency activity on the same layer, as is the case in Solana, where the gas cost or the block time is prohibitive. So, things like new lending primitives evolving, that's really exciting. Things like the Prop AMM wave that we've had of late, that's really exciting and really interesting for the quality of liquidity and pricing, and even things at the degen level, right? Some of the stuff that Solana has had fame and infamy for, it's sort of a testament on some level that these use cases are possible on the same network, where large scale DeFi transactions with institutional assets are happening in parallel, and it's happening at thousands of transactions a second across a public permissionless network. So yeah, it's just a very, very exciting ecosystem to be building in.
Yeah, I think the kind of stress test of the meme coin cycle of 2024 kind of battle tested and hardened the Solana network, and a lot of the haters from 2024 and beyond were kind of silenced because the network was able to prove that it was able to be more resilient and sustainable. Before we kind of delve further into Matariki and what you're working on at Keel, I do just kind of want to hear real quick your super early genesis with crypto. When was the first time you heard about like Bitcoin, Ethereum, Solana? And if you're like me, you're probably a skeptic and maybe you didn't look at it again for another few years. Or if you're not like me, maybe you kind of like got it immediately. Do you remember the first time you stumbled across this crazy asset class and industry?
Yeah, I think my very, very first interaction with it, where I took enough time to read up a little bit and try and figure out what this thing is, was probably, I'm going to show my age. I think it was maybe second year of university at the time. So probably, I guess 2013, maybe 2014. But at the time, yeah, my trying to be smart, trying to be clever was like, there's something up here, I don't get it. And I think I sort of shelved it for a while. I think actually one of my buddies at the time did decide to go in on it, and has had quite a profitable outcome as a result. But no, I remained fairly skeptical, I think, through maybe my first couple of years at college, and started to dabble in DeFi maybe around 2018, I'm going to say. So yeah, dabble, and then once Solana came along, it was sort of 2 feet in. So yeah, that's my story.
Yeah, my story is very similar. I was a broke grad student in 2013, looked at Bitcoin when it just dropped to $600 and thought, oh, this is interesting, and then didn't look at it again for another 4 years, and was kicking myself in the ass for not doing so beforehand. I do I've been traveling the world a lot recently this year, all over Asia. I've been dabbling into LATAM, haven't really gotten my feet wet in Europe. What's the kind of like developer scene, the blockchain scene, like in your neck of the woods? Do you have a lot of local builders? Do you have a lot of local meetups? Um, you relocated from another part of the world, so are you seeing that there's kind of like a grand return of people who might have moved away to previously identified blockchain hubs? Just kind of want to hear what your finger on the pulse is like in your neck of the woods.
Yeah, I mean, I'm based out of Belfast, which is in Northern Ireland. I spent a lot of time in Dublin, spent a lot of time in London. When I first moved back, which was about 2 years ago now, was sort of struggling to find folks to connect with about this, to chat about Solana, to chat about DeFi generally. But very thankful to say that's really started to change in the last period. Solana has a grassroots organization called Superteam. They've just got off the ground in Dublin about a year ago, and I think they've gone from 2 or 3 of us that used to meet up once a month to, I think, something of the order of 200 members now. And that ranges from folks who are just writing their first smart contract to folks who have other other roles contributing to the very significant protocols. So it's really, really been exciting to see. I think there always were a bunch of folks, but sometimes it takes someone to catalyze that and get people together. And it seems like every couple of weeks now you hear of somebody who's just been quietly working away on some insane project. They're just a couple of doors down from you. So it's always exciting to find that. And certainly London, I think these days is really, really booming, both on the kind of grassroots developer side, as well as the institutional side is just really, really taking off. So a lot of exciting stuff happening there on the kind of institutional side of crypto at the moment out of London.
Yeah, that's awesome. I can't speak highly enough of how valuable local communities are, especially during times of negative sentiment and downward activity and just like flat out bear markets. Like to have a group of like-minded individuals that are building in your neck of the woods and you have monthly meetups with or quarterly meetups with, that really does go a long way. So it's super cool to hear that that's kind of growing in your neck of the woods of Northern Ireland. So one of the kind of like key factors of the Keel ecosystem is this relationship with Sky, formerly MakerDAO. So how did you kind of like find your inroads into Sky? I don't know if we hit the record button already, but you said you started integrating and collaborating with them earlier this year. So what did that discovery look like? How did that relationship start? And what was kind of like the genesis moment or the formation of the idea of Keel?
Yeah, so I mean, I've been a sort of relatively long-time observer of MakerDAO from a distance. I think the concept of collateralized stablecoins, and we'd love to get into that in a little bit, but it's always been something that I've seen as a really, really crucial DeFi building block that historically, for a number of reasons, Solana didn't have, right? It didn't have it, brought in from other networks. It hadn't managed to sort of take hold natively. And so when I first heard that USDS was coming to Solana, I was naturally very excited about that. But there was always this skepticism when there are projects making their way over from Ethereum. Is it going to integrate in the right way, right? Is it going to do this in a tasteful, cognizant way that respects the way things are done on Solana? And, that's at the kind of human level, but even at the technical level, the Solana thing is a different beast, right? At the virtual machine level. And so there's certainly been a lot of examples of where that hasn't been done successfully. So through a couple of good friends of mine in the space, we had sort of heard about what was happening, reached out, got in touch, learned more about, from other contributors who are working on this, how they plan to do it. And it was very clear that there was sort of an opening or opportunity for Solana native builders to get involved and have to shape how this would happen. And so that started with contributing to things like infrastructure around the bridge, SVM native infrastructure for things like the Sky Savings Rate, SUSDS, liquidity against other stablecoins, kind of these sort of Sky primitives that everybody benefits from. And so as we were doing that, we were identifying what are the opportunities here, what are the things that are missing for Solana to get the full benefit of USDS, and for Sky to get the greatest opportunity from Solana. And we've been watching obviously very closely what Spark was doing. I know you had Sam on the podcast there. They've been a terrific example, a terrific pioneer for what Sky calls a star model, can do. And effectively, Keel borrows a lot of the same concepts there, although we intend to do things very differently on some fronts. But at the core, we're a capital allocator on chain that dynamically allocates capital between different venues, different protocols, different sources of yield, but gets the benefit of being able to tap into Sky's enormous liquidity and to be able to do that in a very elastic way. So yeah, it's sort of naturally evolved from kind of identifying what is the best way for USDS to grow in Solana, and really it's to have a large institutional scale balance sheet able to dynamically allocate that capital, so it's it finds its best home.
So for somebody who might not have listened to that episode with Sam, or still hasn't been able to fully grok or wrap their head around how you can gain access to this capital and use it to empower an ecosystem, when we're talking about capital allocation, what does that mean? How does this look? Is Sky giving Keel $2.5 billion in stablecoins and saying, go do with this what you will? Or maybe let's just talk a little bit about how we're able to access and effectively move this capital into projects, and what an ownership versus a redirection might look like.
Yeah, I mean, it's a great question, and you're probably going to have to forgive a little bit of jargon here because it's not the most straightforward answer. I would start by saying what it's not. And I think a misconception of what it's not is that this kind of looks like some sort of glorified morpho vault, right? Where there's just a bunch of money this guy, puts up into this vault, it gets allocated by Keel, and, Sky is subject to the losses if we make a mistake. It's not at all that, right? That's sort of one of the ways I think more risk curation has evolved on chain, but sort of this protocol capital allocator is quite different. The other piece of context I think is useful in building up this picture is, for folks that are most familiar with Sky or formerly MakerDAO, you're probably familiar with DAI, which was the original collateralized debt token. And the way it worked originally was you had these things called collateralized debt positions. They were a smart contract. You locked up $100 worth of ETH and you could mint $70 of DAI. Okay, and so that $70 of DAI was backed by an over-collateralization of ETH or some other quality blue chip crypto asset. What Keel's balance sheet effectively is an incredibly complicated CDP, okay? So you've got a whole bunch of assets on it, and you've got liabilities to Sky denominated in USDS, which is the evolution of DAI. And so Keel has this risk capital on its balance sheet, and that's sort of akin to the over-collateralization in the original CDP model. And that is there to absorb first losses. That has to be appropriate for the type of risk and assets that Keel is allocating it to. And if there are any losses on that, they're absorbed by that risk capital, and that's what protects Sky and USDS holders as the most sort of senior creditors in this model from losses. And so this sort of silos the risk and moves the risk off onto Keel's Keel's protocol balance sheet, but it also creates the opportunity for Keel to go and identify these right commercial opportunities, to identify these mispriced allocations, to figure out where there's profitable allocation to be found. And allows Sky and its kind of core governance function to focus on the kind of slower but very, very important big decisions like interest rate setting and like risk setting. So I think it's a very, very interesting model, and it has the right incentive alignment as distinct from where we started in this conversation with kind of just pure risk vaults, where somebody or some entity is calling the shots in terms of where allocation goes, but they've no skin in the game, right? They all the losses are passed back to the the depositor effectively.
So, why would, from Sky's perspective, why would they want to? And this probably isn't the best term, but we'll go high level. Why would they want to offload this sort of? And I don't even want to say it's high risk, but for a stablecoin issuer and provider, this is a little bit riskier when they're going out and they're saying identify these entities that you can create these collateralized debt positions for. What is it in Sky's perspective that they're saying, okay, we want a star to do this. We want another team to be able to do this, and then even further, trust them in an alternative ecosystem. What's kind of like the cost risk analysis or the cost benefit analysis from Sky's perspective on how they're empowering the Keel ecosystem to do this?
That was a terrific question. And I think it it actually goes back to lessons learned from traditional finance. And again, this may be a little bit in the weeds, but one of the core concepts that has allowed traditional financial markets to grow so well and to become so efficient in how they allocate capital is this concept called capital formation. And it basically means breaking up the risk and attributing the risk reward to different categories of people with different categories of comfort with that risk. And so in this model, what you've got Sky at the core. Really, its core function is to issue USDS and ensure that USDS remains sufficiently over-collateralized at all times. That's basically what it wants to do. And it wants to ensure that PEG is always maintained and there is always more than enough, and quite significantly more than enough assets behind it. I think at the moment it's about 140% over-collateralized. And then it also wants to generate a return. And it generates a return so that it can distribute the vast majority of that back to SUSDS holders and generate some protocol profit for its, for the reserve or for Sky token holders or whatever it does with that. But it wants to take very, very, very limited risk in doing so. And so the way it could achieve that, and historically it did, was with these very crude CDPs that were far, far, far over collateralized, or by buying things like tokenized treasury bills. But one of the things that, one of the problems that arises then is USDS doesn't really have this kind of meeting customers or meeting the folks that are demanding it where they are. And so that's one of the things that evolved. Sky brought around D3M, where basically USDS was being sort of minted into Aave, right, or minted into these lending marketplaces to meet borrowers. But if you expand that model, how do you get it into other ecosystems? How do you get it into more and more lending marketplaces? How do you find other profitable allocations or allocations in general? That's possible by having these entities, these stars, these separate organizations that are sort of motivated to go out and find these opportunities, go out and to identify folks who have demand for USDS and meet them where they are. So that's sort of one of the big motivations is sort of for growth, okay, and having these, agile, nimble organizations that can go out and do that. And on the risk perspective, that capital formation that we mentioned earlier is sort of the thing that protects and sort of silos some of that risk, right, where the organizations that are most at the forefront of figuring out the right opportunities have a spread to capture in terms of that outsized return, but also have to eat in most cases all of the risk, right, or the vast majority of the risk associated with doing so. And it's a model that's worked very, very well in traditional finance, and it's a model that I think is very, very promising and very, very suited to this problem in DeFi as well.
Mm-hmm. Mm-hmm. So really quickly, can we just touch on the kind of hierarchical organizational structure of Keel? I mean, if you go and look up who's Cian on crypto Twitter, you're going to find that you're the founder of Matariki Labs. And then there's Keel, which is this kind of like behemoth that is allocating Sky's underlying capital. So there's kind of like 3 different names that are being thrown around right now. So can we just share a little bit about the relationships of Matariki Labs and how that contributes to Keel? And are there other opportunities for other people to come in and build inside and alongside Keel?
Yes. So Keel, I guess, ultimately is a protocol. It's what Sky calls a star. It will, in time, have its own DAO that will make decisions based on kind of traditional token governance. And so it is sort of this. It's this balance sheet, this dynamic allocation, this automated system. It's the framework and the rules to facilitate that. Matariki Labs is a dev shop, a development company, a research office that I set up. I've brought in some of the best talent I've been able to find from past experience across both protocol engineering as well as kind of risk and actuarial. And among other things, we contribute to the development of Keel as a protocol and some of the infrastructure that enables Keel. So that's sort of the way you could think about it. And it is very much intended to be, and very much is, an open, autonomous organization. Keel certainly welcomes contributions from other organizations, and Matariki Labs, I hope, is just one of those organizations in time that will help to develop it and grow it and further it.
Where did you come up with the genesis for the name of Matariki Labs? It's a super interesting name.
So Matariki is the Maori word for the Southern Cross constellation, and so one of the genesis of this idea at the time and bringing this sort of skill set together was on a walk late at night in New Zealand, where you could see that beautiful constellation. So it's it's a throwback to some time I spent a few years back living down there.
Perfect, and it fits very well into the broader Sky ecosystem and the kind of vibes going on over there. So the Keel was kind of like formally announced in Singapore at the end of September. I was out there for Token 2049, and one of the kind of like big numbers that sticks out when you read about this announcement is $2.5 billion from within the Sky ecosystem. So where did this, what's the pool of funding? Is this all available now? Is this being allocated all at once? Is this a pool that you're going to be playing with for a few years? How did this kind of like sticker price number of $2.5 billion kind of come to be? What are kind of like the ways in which you envision distributing this capital into the Solana ecosystem?
It's certainly not a day one dump it all in a market number, that's for sure. 2.5 is sort of what's sort of been discussed in the SES as like an 18 to 24 month roadmap for Keel. So I think there's tremendous opportunity on Solana, and I think the Sky ecosystem is very much agreed on that. But one of the challenges you have when bringing an allocation of this scale to an ecosystem that is still, relatively speaking, in a kind of growth stage, you simply cannot just bring that level of capital and just throw it in a marketplace. So there is a roadmap, and I won't go into all of the details, but broadly speaking, it's across DeFi lending, stablecoin swap liquidity, and tokenized real world assets. Lending, of course, lending markets and over-collateralized lending markets is where Sky historically has been able to play the biggest role and is where it's best fit to do that. So I would personally love to see, but of course, a lot of this is driven by governance and other decisions, really, really growing and scaling the stablecoin lending market participation by Keel. But that's going to take a little bit of time. You have to walk those markets up to the combination of getting folks used to the additional liquidity and other borrowers having more confidence and identifying that there's greater liquidity there. So that's sort of a walk up. But there are a lot of exciting things that maybe we should double click on in a moment around the impact that this will have on rates and the economy as a whole on chain for the Solana ecosystem. The next then is in stablecoin swap liquidity. So I think everyone who's been anywhere near DeFi knows there's been a whole bunch of new stablecoins coming on. A big part of bringing a collateralized stablecoin as opposed to a fiat-backed stablecoin like Circle or Tether is actually ensuring there's really, really high quality liquidity against those fiat-backed stablecoins. So that'll be another part of it. And then the other part, which I'm also excited to chat about, is the tokenized real world asset strategy. So Solana, I think if you look at any of the dashboards, it's kicking ass on almost all metrics. It tends to be sort of 2 behind Ethereum on basically everything TVL related. But one area where it's lagged a little bit has been in tokenized real world assets and sort of institutional to scale assets on chain. And so from Keel's perspective, there's a couple of reasons why it can play a really important role here and on that kind of path to the 2.5 million over the next 18 months. There hasn't been a significant institutional scale on-chain balance sheet on Solana to date, right? Whereas other ecosystems, like Ethereum, have benefited from Sky for many, many years. And so that means you don't have an allocator that has an absolute imperative to demand the highest quality assets on a particular network. And so without that, we haven't had asset managers sort of get over that anchor liquidity hurdle to get over their kind of ROI to invest in tokenization infrastructure on Solana. And so as we joked about earlier, it's not quite as easy to just lift and shift EVM code and deploy it on Solana. So it is quite an investment these guys need to make to get over that hurdle. And then the other thing with RWAs is a lot of it is the network effect, right? You don't really get a lot of the benefits until there already is liquidity in these assets. So I think for Keel, there really is an important role to be played as that catalyzing force, as that instigator to demand high quality tokenized assets on chain, to be the anchor liquidity, to be the holders of those assets, but to hopefully usher in a whole wave of other allocators and other buyers and other traders for these assets to follow once sort of that standard is set. So there's sort of the 3 areas to round it back up of how we get to that 2.5, but it's certainly not something you can do overnight, and we're going to see it kind of ramp up gradually, slowly, and then all at once.
Yeah. So, and please feel free to correct me for putting any words into your mouth or for how Keel is seeking to operate. But based off of what you just said, kind of the takeaway I'm walking away with is here's this massive pool of capital that's being managed. Look, traditional financial institutional partners who want to onboard their RWAs on chain, we can manage this level of capital. So why not explore also bringing your tokenized real world assets into our ecosystem? Is that kind of the playbook?
There's certainly an element of that, and I think someone needs to kickstart the party to some extent in a new ecosystem, and that very much feels like there is a burden of responsibility here for an on-chain balance sheet to do that. And yeah, it's exactly that, and we as advisors to Keel are having tremendous conversations with basically anybody in the traditional finance space remotely interested in tokenization. So there's definitely a lot of excitement here. There's definitely a lot of teams that have spent a lot of time figuring out how to do this. They're sort of waiting for the right opportunity to get over that ROI hurdle and make it happen. And I really think we've started to see some of this happening on other chains, on other networks, on Ethereum for a couple of years. But it really does feel like the tokenization floodgates are about to open. And I think there just needs to be a couple of first movers to make that happen and to create those, the sparks to create those network effects. But I think there's a lot of institutional money on the sidelines waiting for sort of these first moves as well. So hopefully a very exciting couple of months ahead in the tokenization space. But there's a lot of work going on in the background as well to make these things happen.
Without asking to name any names or spill any secret sauce, from what I've been able to glean from some of these kind of first mover conversations is a lot of TradFi entities that are interested in tokenizing a fund or bringing an RWA on chain. They're also asking for a little bit of skin in the game from their infrastructure partners. So are we as an industry still at a point when you're courting a new traditional entity who's trying to bring one of their RWAs on chain? Are we still at a point where an entity might say, we'll come onto your chain, but we need you to invest $5 to $15 million into our fund to sweeten the pot? Are we still kind of at that point, or are we moving beyond where these institutions are kind of not necessarily needing a direct financial incentive of investment into a fund that they want to bring on chain? Or what's kind of the landscape right now like?
The sense I have is that there is still an enormous amount of that happening across networks. I think in particular where you look at any networks where there isn't a natural product market fit already, there is a need for those organizations and those foundations to do a little bit of this sort of pay to play or to plug the hole in the economics to make them work somehow. I think on networks where there is already an established, let's call it a marketplace, or at least the semblance of where network effects could take hold, I think there is less need for that. And I think for projects like Sky more broadly, where there is a legitimate economic motivation to want to go out and buy these assets, because it is backing a stablecoin treasury, because there are profitable allocation opportunities, that to me is a much healthier, much more sustainable way to get these asset managers across the line, to get those first issuances out there, rather than sort of artificially plugging the hole on some of these economics. I think like you alluded to, there is a lot of that happening on some other networks as well. Yeah. So hopefully something we will move past. But as I say, somebody has to start the party in some sense, and sometimes that involves foundations and these other networks plugging the hole in cases to make the economics work.
Do you find that you have to kind of, when you're going out to entities that are coming on chain for the first time, and they're currently in their exploration phase and having conversations with entities like Keel or others, are you finding that you need to kind of evangelize the benefits of the underlying architecture of Solana? Or is this just they don't care what blockchain it is, they want to find a good partner? Or yeah, because I get the sense that you have Ethereum that captures all these RWAs. If you go to rwa.xyz, it's like the market leader. But then there's dozens of others. So do you have to kind of like champion Solana yourselves when you're going out and courting these entities?
It really varies quite a lot. The spectrum of folks you speak to, from how are we putting our fund on a Bitcoin, to folks that really understand the nuances of Solana versus Ethereum versus other networks. A lot of the institutions that are just historically asset managers, this is just another distribution channel for them. They're working with a tokenization platform. They don't really care so much. But I would say there has been a very encouraging number of folks that we've spoken to, where there are real thoughtful tokenization teams within these big institutions that are really flying the flag for what's possible here. And with those guys, there are terrific conversations about what's possible on Solana that's not possible anywhere else, right? Some of the nuances of what you can do, what could we do, not just by issuing this so people can hold it, but if we can find some way to make it composable with DeFi. And certainly for someone like myself, they're the much more interesting conversations, and also a much more, it just gives you a lot more comfort that this is not going to be a one-off project from this asset manager and they're going to shelve it. These guys are going to be here to stay, right? They're going to issue one high-quality asset to get started, but there's probably a whole bunch of these to come, right? And interesting DeFi strategies and interesting ways to be integrated and make them more useful on chain, as opposed to just another version of the same product that's accessible on chain. So it really varies, but I would say on the whole, I've been very pleasantly surprised by the level of engagement and the, if not initial understanding, the like desire to understand more. So yeah, it's been good.
You mentioned that Solana is kind of like rearing up and ramping up, and it's number 2, number 3 behind Ethereum and a lot of other kind of like RWA verticals and asset classes. And if you're a listener and you're listening to this right now and you do go to rwa.xyz, a fantastic platform that kind of shows the aggregation of various different verticals of real world assets that are being brought on chain. There's a lot of different types. There's private debt, there's corporate and RWAs, there's stablecoins, there's T-bills, there's all these kind of like really interesting types of RWAs. What is like the vertical that you're seeing being captured on Solana right now? And what's the kind of vertical that you guys are going after in terms of different types of RWAs that you're trying to bring on chain?
Yeah, I mean, I think on Solana to date, it is still very much in its nascency compared to some other networks. So I won't go too far into it. There's certainly been some excitement about various forms of tokenized equities with varying degrees of legal recourse. We won't go into that. And there's been some very interesting, like more specific native issuances of assets that you could broadly categorize as RWAs. But I think if you zoom out and look at, public blockchain networks on the whole and what assets have sort of taken hold, we had this really interesting period in time where T-bills and money market funds were in such demand, right? And it sort of happened because historically before that, the on-chain economy had its almost subclimate economic environment, whatever you want to call it, right? Where it sort of found its own natural risk-free rate. And it was pretty much entirely disconnected from interest rates in traditional markets. Whereas, of course, in traditional markets, you've got this concept of the Fed rate or the interest-free rate, so the risk-free rate, of which almost every other financial market is built. And then the bringing on of T-bills and money markets funds all of a sudden united these two worlds, right? Where now there was a way to import into DeFi the risk-free rate. And that, it started to flow into many different stablecoin treasuries and many other different primitives. And that sort of then put like a very nice floor in our on-chain economy. But since then, and really over like the last, whatever it's been, 18 months, things on chain have heated up quite a bit, and the demand for capital has increased, the demand for liquidity has increased, and our sort of hybrid rate, if you want to call it that, has been pulled up, which has made things like T-bills and money market funds slightly less interesting to a capital allocator. So the types of assets that you can imagine we're exploring are the types of assets that are consistent with an institution who has very, very short duration liabilities. Okay, because ultimately it's backing a stablecoin, and that stablecoin's primary function is to remain liquid. So that's one of the biggest constraining factors. So any sort of instability is not really something you can tolerate. Obviously, dollar denomination is a big factor. Highly liquid, as I mentioned, and pretty low risk when it comes to risk. I think folks assume allocator is taking quite a significant amount of risk, but really it's the art of identifying yield with low to no risk is really the game we're in as a capital allocator. So yeah, it's stuff like you mentioned. There's the kind of institutional private credit is interesting. Other types of tokenized fund, tokenized yield, things that have worked in the past for other allocators. We're exploring like tokenized off-chain credit, tokenized basis trade. All those categories of assets with sort of dollar-denominated, risk-appropriate yields, high liquidity are kind of the categories of assets that we, as an allocator, are interested in.
Cool. Do you have any direct competitors within the Solana ecosystem that are reaching to the same scale that Keel is?
In the allocation space, not really. I mean, we're certainly aware there are a number of whales in like the lending and stablecoin liquidity space, but they're a very different beast, I guess, when it comes to protocol-owned liquidity that has access to sort of the elastic scale of Sky. I know in the context, for example, of Spark, there's Sparkland, which is a lending marketplace as well. Keel very much is a liquidity layer and not so much a product. And so we're in this nice position where we're sort of friends with everyone, and we're able to be friends with everybody because liquidity is great for everybody, and we don't really have to be competitive in that sense. So it's a very, very nice position to be in as an ambassador of a project that is largely just here to hopefully benefit as many people as possible.
Cool. And in that vein, what's the relationship with the Solana Foundation like? I would imagine it's very open and amicable. Are you seeing a lot of conversations being opened and lines of communication being opened as a result of an introduction of the Solana Foundation? Are you guys having planned communication processes whereby maybe like once a quarter you're meeting with them to share what's going on? I'm just really curious to hear what a team from your scale and caliber, what a relationship with an ecosystems foundation looks like.
Yeah, I could tell you it's certainly a lot more than once a quarter. We work very, very closely with the Solana Foundation and get terrific support from many of the different stratas there. And it's been a really, really helpful relationship. Well, certainly in this direction, I hope in both ways in terms of opening doors where, I keep using the word catalyzing, but it really has been that effect for a lot of institutions where all of a sudden there is real allocation at stake. And so in terms of folks coming to speak to us through the Solana Foundation, but also folks coming to speak to the Solana Foundation through us to figure out what they need to do, to have a successful tokenization, to launch this project for more than one customer, to figure out how they interact with DeFi or the various people in the solution stack, right, from oracles down to liquidity solutions down to tokenization. So it's very, very much, I think, a mutually beneficial relationship with the Solana Foundation, and have a lot of time for really all the guys there. They've been incredibly helpful.
Awesome. We also had the Solana Foundation on the pod back in late 2023 as well. So shout out to that team. I guess one of the things I'm interested in hearing about is, what would you say is the number one kind of like friction point when a team is exploring building on Solana? What's the number one thing that you find you're helping to hold their hands as they walk through the process of building on this chain and this ecosystem?
It's a good question. We did touch on it earlier that like the tech is very different. There are a lot of very different programming paradigms. Solana as a place to build is a lot less opinionated for an engineer than I think much of EVM development is. So there are less kind of standards set, less common practice established. So I think there's a lot of kind of figuring things out for the first time that you shouldn't necessarily have to. So that certainly can be a bit of a challenge, especially if you come at it from the assumption that this will be easy to replicate where we've done something elsewhere. That's probably the big one on the tech front. Aside from that, I don't know that I have too many other major problems. Maybe that comes from a place of having been sticking around so long and just generally loving the place. But yeah, I think that's really the only thing that comes to mind right now.
Yeah, I mean, super interesting and valid. It's a completely different VM and ecosystem to build within, and there's this is also a question I'm interested in digging into a little bit. What are the kind of benefits that come from building within like a monolithic ecosystem as opposed to the modular kind of like OP ZK stack of EVM land? What are the benefits that come from just like doubling down and building on Solana, which is like very monolithic, and you're not going to have to worry about L2s or even L3s at this point?
I think the big one for anything financialized is, I'll do my best to explain, but I think Solana's internet capital markets thesis is like a very, very good summary of it. And really what that says is, hey, on an L1 like Solana, that is a high throughput network, you sort of get the best of both, right? In that the activity that is low latency, high frequency, things like price discovery, things like credit creation, things like liquidations, can actually happen in the exact same place as settlement happens, right? Where your like asset security takes place. And that's incredibly powerful, right? As distinct if you compare that to an L2 based system where those high frequency activities can happen somewhere else, but there's still quite a gap between the settlement, right? So you've got the benefits of things like capital efficiency, funds don't need to be moved and queued and bridged. You can have those marketplaces take place milliseconds from where they're ultimately settled. And I think that's really, really, really impactful and really powerful. And from Keel's perspective, the opportunity there is, depending on who you listen to, there's a $20 to $30 trillion market of collateral assets coming on chain in the next 10 years. Where do we think they're going to end up? They're going to end up across a whole bunch of different public blockchains. But if you look at what networks are going to have the capacity to handle the sort of volume that's needed for the high frequency activities like credit creation, which Keel is involved in, to me, a lot of that credit creation is going to happen in the network where you have settlement of those assets, not having to leave that same network. So that to me is what sort of boils down the Solana thesis and part of the excitement for Keel and the opportunity for Keel in Solana.
That 30 billion coming on chain, and sure, maybe it's a conservative figure, maybe it's not. I think it's definitely just the general trend of where the hockey puck is going and where we should be skating to as an industry. What is this large number of RWAs coming on chain? What is this comprised of? It could be 20 billion, it could be 30 billion, whatever. What are these RWAs? What are these assets that are coming on chain generally going to be?
First of all, I got to correct myself. I think I used the B, but I intended to use the T. I think the predictions most are looking at across, whether it's Standard Charter or BCG, are predicting 20 to 30 trillion in tokenized assets coming out of public blockchains in the next 10 years. So that really is, a significant multiple from where we stand today. Now, the big question is, right, how many of these assets will be composable or have the ability to compose with DeFi, right? That's sort of what constrains potentially the opportunity that I just described. But you have quotes from folks at BlackRock that say, in the next 5 years, either all of their assets will be tokenized or none of their assets will be tokenized, right? And that's, books of thousands of different ETFs across all categories of assets and allocations. So there really is this kind of inflection point where I think, the first asset manager maybe does an experiment with 2-3 different ETFs. Somebody else does it with 2 or 3 funds. But if these prove successful, the marginal cost to tokenize the rest of their offering is negligible, right? So I think there's a lot of what we're seeing right now is sort of the very early experimentation. It's been taken very, very seriously and been done correctly, I hope. But the floodgates really, really could open for a lot of different categories and offerings. And
I also probably misused the BT or M in terms of billion, trillion, or million in this conversation. So apologies if I did so in the past. Okay, cool. So as we kind of like zoom out and wrap up, you mentioned earlier that you wanted to touch a little bit on the value prop of over-collateralized stablecoins. And I'm very well aware that I'm about to throw in 2 different types of stablecoins that have nothing to do with one another. But for a lot of OG ecosystem participants, they might have this kind of hangover from anything that's not a fiat-backed stablecoin. I'm specifically talking about the Anchor unwind from the from 2021, and that was an algorithmic stablecoin, very different from an over-collateralized stablecoin, but it might get easily lumped in to a non-fiat-backed stablecoin. So for anybody who has a little bit of consternation or might think that a crypto collateralized, over-collateralized stablecoin is risky because they're inadequately or wrongly or however you want to put it, conflagrating the two algorithmic stablecoins with over collateralized stablecoins. How do you kind of deal with this underlying assumption of risk that people might have when it comes to using an over collateralized crypto backed stablecoin? Are we in a place where something that like USDS can compete with and if not be better than a USDT or a USDC? Or are we still kind of like fighting this uphill battle of preconceived notions that people might have about crypto collateralized stablecoins because of past examples of failures in blockchain financial infrastructure systems?
I think the way I'd respond to this question is probably first by categorizing some of these different buckets of stablecoins. So if I can be so bold as to sort of try and set out a taxonomy, and then I think the next piece then is to sort of say that none of these stablecoins are inherently good or bad overall, right? They're better or worse for particular use cases is the way I'd come back to you. So if we say there's kind of three broad buckets, I'm going to say fiat-backed stablecoins. Let's call them payment stables. We've got kind of more speculative assets like strategy-backed stablecoins or algorithmic stablecoins, which are really there as a unit of account for some investment, right? As opposed to actually being a sort of unit of currency, right? I know a lot of folks still call them stablecoins, but a lot of the time what you're really buying is a dollar unit of some exposure to some investment, right? And then the third is over-collateralized stablecoins or debt tokens like the USDS and DAI. And so the second category is the one that folks often get nervous about, and as they should in some cases, because they're sort of come across or marketed as a stable coin as like a unit measure, but really they're a unit of claim in some sort of strategy that may have a whole wide array of risk. The first category, payment stables, I think the use case is very clear. They're probably crypto's most obvious product market fit. They're a means of moving a claim on fiat around the internet, fast and cheap, and they're really, really good at that. And then lastly, we've got the debt token DAI USDS. It's sometimes used as a means to settle payment, but it's never going to be competitive with Circle or Tether as a payment stablecoin, right? It has one further step removed when you need to off ramp. But what it's really, really good at is as a unit of credit creation, as a unit of debt creation, and a way to sort of move the value that's created there to folks that stake it while still having a claim on the underlying value. Right, and so it behaves much more like what economists call M2 in traditional finance. Right, it's got this sort of superpower in its elasticity and its ability to make markets function better, make rates more stable, meet borrowers where they need credit creation, and to create value and pass that back to folks on the savings side in a way that is much more secure and collateralized and safe than some of these more speculative stablecoins or sort of strategy-backed stablecoins. So, yeah, I think to summarize, it's not that any one is inherently good or evil. It's that there are tools for jobs, and certain stablecoins are the right tool for certain jobs. And certainly on the credit creation side, debt tokens or collateral-backed tokens are really the way to go.
Awesome, and I kind of want to wrap this interview up with something that we could probably speak for hours about. So apologies for lobbing a highly complex kind of issue at you as our final question. But we're on the heels right now of a major hack that happened in the Balancer ecosystem. And there was a $110 million hack. And this contagion spread to other blockchains in EVM land, Sonic, Polygon, and Base. It seems every quarter or so, almost every ecosystem is at risk of dealing with one of these large-scale DeFi attacks. So as you kind of take it on your shoulders in the Keel ecosystem to onboard institutions, how do we navigate these waters of protecting like RWAs and assets that are backed by RWAs from suffering from this contagion? And how do you kind of reassure traditional entities that this is something that has happened ever since DeFi has been a thing in blockchain? And these are the kind of like mechanisms we're going to put in place to shield or avoid you and your assets from falling victim to these things that have contagion throughout blockchain ecosystems.
It's a very good question. I think the first thing I would say is it's a very important reminder, and it's never good that these things happen, but they do serve as a very important reminder that there is no such thing as zero risk on chain, and that security audits, audit contests, bounties, all of these things play in a really, really important role in trying to reduce that risk, and doing that in a sensible way, and doing that to the best of whatever the capabilities and resources are at the time, but that they never entirely remove that risk. And one of the ways you deal with that at scale is to some extent trying to reduce concentration, right, or improve diversity of exposure. And that hasn't necessarily always been possible historically, because there have been a small number of key winners in a lot of DeFi because of the sort of monolithic effect of liquidity. But I think that is improving, and the ability to sort of diversify allocations across different networks is one of the things that sort of brings that benefit. I think education is a big part of it. I think there's no point in going out to speak to folks and try and pretend that these risks don't exist. It's probably important to call out what these risks are and make sure folks understand it. And I think certainly the Sky ecosystem has been a big advocate of transparency and sharing findings, sharing data, sharing whatever they can to demonstrate what's underlying this. I think when it comes to tokenized real world assets, there's some sense in which the risk is reduced slightly through, it's two sides of a coin. Full legal recourse assets also carry a claim off chain, in addition to the representation on chain. And to some extent, they introduce less exposure to those assets where it comes to folks just holding them. But there will always be a degree of exposure introduced when they start to interface and integrate with DeFi. And so I think that's something that is still being figured out. But I think the risk is slightly reduced by the nature of having full legal recourse for these assets underlying.
Awesome. Thank you for handling that kind of complex question with brevity at the very end of our interview. So for anybody who's listened to this, who do you want to reach out to, and what's the best way that they can get in contact with you?
Yeah, I mean, you can follow along on Keel_Fi on Twitter. If you'd like to follow me personally, it's Croc Dundalk. We'd be delighted to hear from any folks that are interested in contributing, learning more. We're excited to build and excited to have folks build alongside us. So yeah, and thanks for having me on, Dylan. I appreciate it.
Absolutely, Cian. I think RWAs are kind of like the biggest killer use case that are going to be coming in, that have been in blockchain for the past year or so, and will continue to do so. So it was an honor to hear what you're building at Keel, and to hear more about how you're courting institutions and helping these guys figure out the best ways that they can come on chain. So I appreciate your time.
Amazing. Thank you.
Cheers. Thank you for tuning in to the Smart Economy podcast. To stay in the loop with all of our latest episodes and insights, please head over to www.smarteconomypodcast.com. Don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and bring even better content your way. We'd also love to hear from you, so please drop a comment on Spotify or YouTube to share what topics you'd like us to cover next, or who you'd like to see as our next guest. And if you or someone you know might make a great guest, please reach out. We're always looking for fresh voices and new perspectives. And for our NEO token holders out there, please consider voting for NEO News Today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and we'll continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. With all that said, thank you so much for listening, and we look forward to catching you next time.